We open on a market holding its breath. As of the 5 AM GMT close on May 3, 2026, Australian dollar to US dollar is pinned at 0.71992, essentially unchanged from the prior session's 0.71988 close, the range for the entire day locked into a razor-thin band with the open, high, and low all printing exactly at the same level. On the surface, this looks like total stasis. But beneath this quiet price surface, we have an RBA rate decision just 48 hours away, speculative positioning at record extremes, a US dollar that cannot find its footing, an iron ore holding above $109 per tonne. The technical setup on the Australian dollar right now is one of the most compelling and asymmetric opportunities across the entire G10 foreign exchange complex. The market is coiling. And when coils compress this tightly, the eventual expansion, usually triggered by a catalyst event like a central bank decision, creates the kind of volatility that can define a trader's entire month. So let's break this down systematically, the alpha market meridian way, technical structure first, then the fundamental drivers, and finally 3 fully specified profit strategies scaled by risk appetite, with the stop-loss discipline that separates professionals from amateurs. Let's begin with the charts you provided. On the daily timeframe, we can see that Australian dollar to US dollar has constructed a textbook as visible on the daily chart, and has since carved a series of higher lows and higher highs. The moving averages tell the story with mathematical precision. The MA5 sits at 0.70938, the MA10 at 0.70486, the MA20 at 0.69447, and the MA40 at 0.67826. This is what technicians call a bullish fan. Every shorter duration moving average is trading above the longer duration ones, and the gaps between them have been widening, which indicates trend acceleration rather than exhaustion. The current spot price of 0.71992 is trading more than 400 pips above the MA20 and nearly 4,200 pips above the MA40. That is a significant premium, and premium of this magnitude warrants careful attention. Are we extended? Yes. Is that a problem? Not necessarily, provided you understand what drives corrections in a trending market. The daily MACD shows a reading of 0.01499 on the signal line, with a histogram at 0.00606 and the zero line at -0.00287. The MACD line remains firmly above the signal line and well above the zero threshold, confirming that the uptrend is intact and that momentum, while potentially decelerating, has not yet flipped. Importantly, the daily chart shows resistance near 0.72280 and 0.72150, which are the immediate barriers the pair needs to chew through. These levels correspond to the highs we saw in late April and early May. The fact that we closed at 0.71992 on Friday, just below those levels, tells us that the market has not yet summoned the conviction to break out, but it has also refused to pull back meaningfully. Consolidation just below resistance, rather than rejection, is often a precursor to continuation rather than reversal. Now zooming into the 60-minute chart provides tactical granularity. On the hourly, the MA5 is at 0.72044, the MA10 at 0.72080, the MA20 at 0.72004, and the MA40 at 0.71877. What stands out immediately is the compression. All 4 moving averages are clustered within approximately 20 pips of each other. When short-term moving averages converge to this degree, it signals a market that has lost directional conviction in the very near term and is awaiting a catalyst. The 60-minute MACD reads 0.00174 on the signal, with a histogram at 0.00011 and the zero line at -0.00153, essentially flat, confirming the absence of intraday momentum. Price has been trading in a tight range between approximately 0.71690 on the downside and 0.72304 on the upside over recent sessions. The absolute high visible on the hourly is 0.72280, which aligns almost perfectly with the daily resistance zone. This convergence of resistance across timeframes strengthens its significant intermediate trend, while up is maturing rather than accelerating. The weekly resistance zone extends up to 0.72359, with the MACD showing 0.00774 on the signal, 0.00093 on the histogram, and minus 0.00588 at the zero line. This MACD configuration is bullish but decelerating, which is entirely consistent with a market that has traveled a long distance, from 0.63158 to 0.71992, and is now pausing to digest gains. Key support on the weekly resides at 0.71332, with deeper structural support at 0.70305 and 0.69278. The 0.68251 level visible near the bottom left of the weekly chart represents the origin point of the current structural advance. So what is the technical synthesis? Australian dollar to US dollar is in a confirmed uptrend across all timeframes, daily, weekly, and the broader structure since February. The immediate picture is one of consolidation below a resistance cluster at 0.72280 to 0.72304. Break above that and the next targets are 0.7250, then 0.7282, which was the June 3, 2022 high, and ultimately the psychological 0.7300 handle. On the downside, initial support sits at through each one because understanding the drivers is what transforms a price pattern from a guess into a high-conviction thesis. First pillar, the Reserve Bank of Australia's monetary policy trajectory. The RBA meets on Tuesday, May 5, literally 2 trading sessions from now, and the market is pricing in a 25 basis point positioning and capital flows. The latest CFTC commitment of traders data, released on May 2, shows that speculative non-commercial net long positions in the Australian dollar jumped from 64,800 contracts to 71,900 contracts, an increase of 7,100 contracts in a single week. That is a substantial move, and it pushes positioning to just shy of the record high. Asset managers have also nudged their net long exposure close to all-time highs. What this tells us is that institutional money, hedge funds, real money accounts, macro funds, is betting in size on further Australian dollar appreciation. The rationale is straightforward: a widening interest rate differential makes holding the Aussie more attractive, particularly against a US dollar that is being weighed down by expectations of a Fed pause. However, I must inject a note of caution here. When speculative positioning becomes this lopsided, when everyone is leaning the same way, the risk of a sharp positioning unwind increases materially. A crowded trade is a fragile trade. Any negative surprise, a weaker than expected RBA statement, or a sudden spike in US data, or an escalation of geopolitical tensions that drives safe haven flows into the dollar, could trigger a rapid liquidation of these longs. This does not invalidate the bullish thesis, but it demands rigorous risk management, which we will address in the strategies section. The third pillar is commodities. Australia is a resource exporting economy and the Australian dollar has historically traded as a commodity currency, highly correlated with iron ore, coal, and increasingly gold. Let's look at the data. The Misteel 62% Australian Fines Forward Price Index stands at $109.75 per dry metric ton as of the week ending April 30, up 0.55% week over week, with the monthly average for April at $108.80 per dry metric ton, up $1 from the prior month. Iron ore prices have been trading in a $108 to $109 range, which represents a significant recovery from the lows of 2025 when prices briefly dipped below $95. What is supporting iron ore? Despite the narrative of a slowing Chinese economy and contracting steel production, the reality on the ground is that inventory restocking demand has kept physical buying active. Chinese port inventories have been declining, and steel mill margins, while compressed, have not collapsed to levels that would force significant production cuts. Higher freight costs due to Middle East shipping disruptions have also contributed to higher delivered iron ore prices by raising the cost of transportation from Australian ports to Asian buyers. Separately, gold, which has overtaken liquefied natural gas as Australia's second-largest export commodity, continues to trade near record highs, driven by central bank buying and geopolitical safe haven demand. Australia's Department of Industry recently raised its commodity export revenue forecasts, specifically citing iron ore demand resilience and gold price strength as key support factors. The combination of firm iron ore and surging gold exports is a powerful tailwind for Australia's terms of trade and, by extension, for the Australian dollar. The fourth pillar is the US dollar side of the equation, which deserves as much attention as the Aussie side because this is a currency pair. The US dollar index has declined approximately 1.8% in recent weeks, broadly consistent with its historical seasonal pattern of May weakness, though slightly less than the 2.2% average decline observed since the year 2000. The dollar's decline is being driven by market expectations that the Federal Reserve will remain on hold through the end of 2026. While some Fed officials, notably Minneapolis Fed President Neil Kashkari, have warned that a significant energy price-driven inflation shock could force the Fed to hike further, the market is not buying that scenario with any conviction at this stage. The ISM manufacturing PMI print, due later today, will be a key input. A strong print could lend the dollar temporary support by reminding the market that the US economy is not rolling over. A weak print would further reinforce the narrative of US economic deceleration and lend additional support to the Australian dollar to US dollar upside. The geopolitical backdrop introduces a complex dynamic. On the one hand, tensions in the Middle East, including the ongoing closure of the Strait of Hormuz and the possibility of further US-Iran military escalation, have historically been dollar positive because they drive safe haven flows. On the other hand, these same tensions are energy inflationary, which hurts the US more than it hurts Australia because Australia is a net energy exporter. Interestingly, reports that Tehran has submitted a new diplomatic proposal to Washington have temporarily softened the geopolitical risk premium in the dollar, giving the Aussie some breathing room to retest the 0.7200 handle. The interplay of these four pillars, hawkish RBA policy expectations, bullish speculative positioning, supportive commodity prices, and a dollar under broad pressure, creates a fundamental backdrop that aligns with the technical uptrend we identified earlier. However, the near-term direction of this pair will almost certainly be determined by what happens on Tuesday at the RBA meeting. A hawkish 25 basis point hike, accompanied by forward guidance that leaves the door open for further tightening, would likely be the catalyst that finally breaks Australian dollar to US dollar through the 0.7230 for resistance and sends it towards 0.7250 and 0.7282 in the subsequent sessions. Conversely, if the RBA delivers a dovish hike raising rates but signaling a pause, or if Governor Bullock's statement is interpreted as less hawkish than the market has priced, we could see a sharp unwind of those crowded long positions, potentially driving the pair back to 0.7150 or even 0.7100 within hours. This is what makes the current setup so compelling for traders. The range of potential outcomes is wide, but the direction of the resolution is not random. It will be determined by an identifiable, scheduled event, which means we can structure positions in advance to benefit no matter which way the price breaks, provided we respect risk. And that brings us to the strategies. I will now present three strategies, one for the conservative beginner, one for the intermediate trader, and one for the advanced operator, each with precise entry, stop loss, and target specifications. No hand-waving, no vague suggestions. This is Alpha Market Meridian, actionable, specific, risk-managed. Strategy 1 is designed for the conservative beginner or risk-averse trader. This is a breakout confirmation strategy. The premise is simple: do not try to predict the breakout. Wait for it to occur, confirm it, and then trade with the direction of the resolution. The trigger is a 60-minute candle close above 0.72320. Note that this is slightly above the 0.7230 for resistance visible on the chart, providing a small buffer against a false breakout. Once this candle closes, enter a long position at market. Set the stop loss at 0.71880, which sits below the hourly MA40 at 0.71877 and below the Friday consolidation zone. This gives you roughly 44 pips of risk on the trade. The first take-profit target is 0.7270, which captures the lion's share of the expected move toward the 0.7282 high. A second tranche, if you want to scale out, can. Target 0.7300 for roughly 68 pips of total potential profit. The risk-reward ratio on this setup is approximately 1 to 1.5 on the first target and 1 to 2 on the full target. Position sizing is critical here. Never risk more than 1% of your trading capital on a single trade. If your account is $10,000, your maximum loss on this trade must not exceed $100, which means your position size should be approximately 0.23 standard lots, or 23,000 units. The advantage of this strategy is that it keeps you out of the chop, avoids the pre-RBA anxiety, and only commits capital once the market has declared its hand. The disadvantage is that you will miss the first 20 to 30 pips of the move, but that is the price of certainty. Strategy 2 is the intermediate level range-based accumulation strategy. This is for traders comfortable with entering positions before the breakout and managing them through volatility. The approach is to identify the support zone that has been holding during this consolidation, specifically, the 0.7150 to 0.71690 zone that aligns with the hourly chart's lower range. Place a limit order to buy at 0.7160, which is just above the 0.7150 support level and within the range that has consistently attracted buyers over the past week. The stop loss goes at 0.7120, below the Friday swing low and below the 20-day SMA at 0.7121, protecting against a deeper correction. This gives you 40 pips of initial risk. The first take-profit target is 0.7220, which captures the move back to the top of the range. The second target is 0.7270, and a third trailing target can be set at 0.7300 if you hold through the RBA. The risk-reward on the first target is roughly 1 to 1.5, and on the full target it expands to 1 to 3.5. The key to this strategy is scaling. Start with a half position at 0.7160, and add the second half only if price pulls back to 0.7140 and holds. That second entry point is the 0.71383 level visible on the hourly chart, which has acted as a springboard multiple times. If price breaks below 0.7120, exit entirely and reassess. This strategy rewards patience and discipline, and it is particularly suitable for the environment ahead of a central bank meeting, where pre-positioning can capture the initial move before the breakout traders even enter. Risk no more than 1.5% of total capital across the combined position. Strategy 3 is the advanced dual scenario option-based strategy for experienced traders comfortable with derivatives. This strategy is designed to profit from the expansion in volatility itself, regardless of direction. With the RBA decision imminent, implied volatility in Australian dollar to US dollar options has risen, and this presents an opportunity to deploy a straddle, specifically, an at-the-money straddle with expiration 1 week out. Buy a 0.7200 call and a 0.7200 put with a combined premium outlay of, let's assume, approximately 120 to 150 pips depending on the exact volatility surface at the time of execution. The break-even points are 0.7200 plus the total premium on the upside and 0.7200 minus the total premium on the downside. If Australian dollar to US dollar moves more than 150 pips in either direction from 0.7200 by expiration, the strategy becomes profitable. Given that the RBA decision alone can produce an intraday range of 100 to 200 pips, and given that the range from the lower support at 0.7100 to the upper resistance at 0.7300 is precisely 200 pips, the probability of a break-even or better outcome is statistically favorable. Manage the trade actively. If the price breaks and closes above 0.7250, sell the put to recover residual premium and let the call run towards 0.7300. If the price breaks below 0.7130, sell the call and let the put run towards 0.7050. The maximum risk is the premium paid, and sophisticated traders can further reduce premium outlay by selling an out-of-the-money strangle against the long straddle, converting it into an iron butterfly, but that is beyond the scope of this script. The critical discipline with this strategy is to exit before expiration even if the price is between your break-even points, to avoid the theta decay that accelerates in the final 48 hours. This is an advanced strategy and should only be employed by those who fully understand option Greeks and are prepared to lose the entire premium if the market remains stagnant. Let me now address risk management explicitly, because this is where most traders destroy themselves. The single most important rule in trading. The Australian dollar right now, or any currency, for that matter, is that you must not carry unhedged positions into the RBA decision on Tuesday unless your position sizing is small enough that a 200 pip adverse move would not blow up your account. Central bank decisions are binary events with fat-tailed distributions. The market can gap. If you are holding along and the RBA surprises with a dovish hold, Australian dollar to US dollar could drop 150 pips before you can even get a fill on your stop loss. Slippage is real. The second critical risk factor is the positioning risk we discussed earlier. CFTC long positions near record highs mean that if the market does turn, the turn will be violent. This is not speculation, it is market mechanics. A crowded trade unwinds fast. The third risk factor is geopolitical. The Middle East situation remains fluid. An escalation that closes oil shipping lanes further could spike energy prices and trigger a risk-off move that benefits the dollar against commodity currencies, temporarily overriding the interest rate differential logic. The fourth risk factor is Chinese economic data. China is Australia's largest trading partner by an enormous margin. Any significant negative surprise in Chinese industrial production, steel demand, or property sector indicators would directly hit iron ore prices and, by extension, the Australian dollar. Keep the National Bureau of Statistics release calendar on your radar. To summarize the key takeaways from today's analysis of Australian dollar to US dollar. The pair is in a confirmed uptrend on all relevant timeframes, consolidating just below a critical resistance cluster between 0.72280 and 0.72304. The technical structure, bullish moving average fan, positive MACD, higher lows, supports further upside, while the consolidation itself suggests the market is coiling ahead of Tuesday's RBA decision. The fundamental backdrop is overwhelmingly supportive, the hawkish RBA expected to hike by 25 basis points to 4.35%, speculative positioning at near-record bullish extremes, iron ore holding above $109 per tonne, gold at all-time highs boosting Australia's terms of trade, and a US dollar under broad seasonal and policy-driven pressure. The key variable is Tuesday. The RBA's rate decision and Governor Bullock's forward guidance will determine whether this coil resolves upward towards 0.7300 or downward towards 0.7100. For the conservative trader, wait for the breakout confirmation. For the intermediate trader, accumulate on dips to the 0.7150 to 0.7160 zone with a tight stop below 0.7120. For the advanced trader, a volatility straddle captures the expansion irrespective of direction. Above all, respect the risk. Never risk more than 1 to 2% of your capital on any single trade. No matter how compelling the setup appears, and this one is compelling, the market owes you nothing. It will do what it does, and your job is to manage your exposure so that you survive the losses and let the winners compound. That is how you turn volatility into profit, the Alpha Market Meridian way. We will be back tomorrow with a full post-RBA breakdown. Until then, trade smart, stay disciplined, and always protect your capital.